Inflation data pleasantly surprised equity investors. Germany's economy remains moribund, and options traders made some big bets, and we're going to talk about that and take your questions today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So, we had a couple things we were going to touch on from our live stream on Monday. A couple quick things to cover. Obviously, the markets are doing very well today. The reason for this was the economic data, specifically the inflation data that came out today. That was a pleasant surprise. After only a week ago, the expectation was that perhaps rate cuts were off the table for even all of this year. But if we bring up my screen, we can see that there were a couple specific categories where the inflation data came in better than the survey numbers had indicated. So specifically, the areas where they saw better than expected numbers was the CPI ex food and energy. And speaking of energy, crude is up a couple bucks today. That came in 0.1% better than expected. And then that was the month-on-month number, and then the year-on-year number, same thing, came in slightly better than expected. And I think maybe if there was a whisper number against the survey, we could say that the expectations were based on all of the data that people were getting last week, that maybe that would be worse than the survey, but in fact it came in slightly better. So the other thing that's propelling markets, it should be said, are very good results from those banks that have reported. So we can take a look at some of that. And actually, I would also point out that in many instances, what we're seeing here is a lot of options activity in some of those banks that are doing very well. So let's just go over a couple quick examples. Actually, I'll leave this on my screen for a second because I'm sorry, I don't remember who it was, but somebody was asking about Edison International last week. Stock obviously got very hard hit as a result of the Southern California fires. In fact, a lawsuit has already been filed against the company in connection with those fires, even though the company continues to deny that their equipment had anything to do with it. And as far as I know, there's no evidence suggesting that their equipment did cause a fire. It should also be said, with respect to the Palisades fire, which is the most damaging of the several fires that they have down there, that the Pacific Palisades fire, the source of ignition that they've identified is very close to the area where they had put out a fire several days earlier. So there were reports that people were setting off fireworks. A fire started in a certain region of Pacific Palisades. They put the fire out, or so they thought at least. Spent several hours up there. Apparently, people in that neighborhood had reported hearing fireworks in some of the days following that event. And then, at the moment at least, it looks as if the Palisades fire ignition source occurred very close to that same location. So, different theories that are being bandied about are that the fire was not put out completely the first time around, and then some lingering ember reignited several days later. Another possibility would be that the people who were setting off fireworks, whether it was the same group or a different one, but in the same location, set off the fire. So I only bring that up not because I'm interested in the arson investigation, but whether or not Edison International is responsible for that. Now, interestingly, this is not the only lawsuit that Edison now faces, because there are a lot of plaintiffs' attorneys on the shareholder side whenever a stock moves adversely against shareholders. Almost always you get plaintiffs' lawyers looking to file cases against the company. And such is the case in Edison's situation now. In fact, let's see if I can find who it might be. So the Shaw law firm, national shareholder rights litigation firm, announces that it is investigating claims on behalf of investors. This is from a statement that they put out, of Edison International for violations of securities laws, and the investigation is focusing specifically on whether or not the company issued false and or misleading statements and or failed to disclose information pertinent to investors. Now, this is kind of a catch-all because, of course, whenever some idiosyncratic risk event comes up, someone can claim, oh, well, we weren't adequately informed of the risks as investors. Additionally, they're saying that utilities are required to report whenever a government entity launches an investigation into whether their equipment caused a wildfire. So this is interesting. So utilities are required to report whenever a government entity launches an investigation into whether their equipment caused a wildfire. Now, I don't know whether the government investigating how a fire started is an investigation into whether or not Edison International's equipment caused it, using the exact language that the law firm did in their statement. But of course, this is going to happen. So, one of the questions that was asked is it too soon to play for a rebound? Apparently, that investor did. If you did, congratulations, because I think the stock did rebound pretty nicely within the last couple of days. Up 7%. So that will have worked out. Of course, those options premiums are also pretty juicy. But, these are the things that are sitting out there. So just so we're aware. Now going on to bank earnings, because there were several that reported today, and the results have generally been very, very good. What's interesting about this is that there has been a suggestion that the capital requirements were, holding financials back to a degree. That and also the, relative flatness of the yield curve that we experienced for a while. So, so this is just sort of a general rule of thumb, back of the napkin kind of way that people like to think about a lot of these banks, and whether or not the economic environment that they're in is a favorable one. They talk about how steep the yield curve is and its impact on their net interest margins. The logic on this is that banks borrow money short and they lend long. That is to say that they borrow money through demand deposits. People put money into the bank. You pay them interest to make those deposits, and then you turn around and you lend that long. So 15, 20, 30-year mortgages, commercial loans, and so on. Of course, there's also auto loans, which are going to be typically much shorter in terms of their maturity. It should be said, though, that one of the things I don't like about that simplification is that affects different banks very differently. A couple of things going on there. One of the issues for sure is that if a bank holds a lot of duration on their balance sheet, whether they choose to mark this to market or not, as rates rise at the long end, the value of the assets that they hold on their balance sheet decline. And that doesn't necessarily create a liquidity problem immediately, because they have mechanisms by which they can borrow against those assets if they should need liquidity. But obviously there is a limit to that, as Silicon Valley Bank demonstrated. And the other thing is they can get upside down. So that's essentially what happened to Bank of America. Bank of America had a lot more duration on their balance sheet than, say, for example, JP Morgan did. But so let's just take a look at that then and see how some of these banks did, because most of them are sharply higher today. So JP Morgan, they reported today. They reported 488. That was a beat of about 17% on the consensus estimate of 410. We had, let's just quickly see here, who else reported today. We had Goldman Sachs Goldman Sachs, we got 11.94. That was a substantial beat. Stocks up sharply. Street was looking for $8.20. That's a beat of 45%. So really pretty exceptional there. I know that the company cited higher volatility on their trading side as one of the reasons that they had this improvement. Citibank reported $1.33. That was a much more modest beat of only about 11 cents. We had Wells Fargo reporting, and actually we'll take a look at what's going on elsewhere, because I also saw that U.S. Bank had a big. So here you only had a beat of about 8 cents on the Wells Fargo side. Of course, Wells Fargo still trying to come out from under a lot of the controversy that had prevented an aggressive growth, because they were essentially constrained as part of a punishment for some of the things that the bank had committed earlier, including opening up accounts without clients' permission. But I'm assuming they're going to get on the other side of that, and the stock does trade at a decent discount to the rest of its peers for this reason. And let's just take a quick peek also at U.S. Bank, because I saw that there was a lot of activity on the option side in U.S. Bank. So here, only a beat of about 4%. So I'm a little bit surprised that the stock's performing as well as it did, but there's probably something buried in there that is telling a more favorable story. So just very quickly, also taking a look at some of the unusual options activity. We were just talking about Edison. I'm going to go back to that really quickly so we can see where people are placing their bets. Feb 67.5 calls were the most active. This is a name that trades about 3,000 contracts a day on the call side on average. Very nearly 6 times that number today. And actually, what was I saw? See if I can remember what the other one was that I saw really unusual activity. It was I think. Oh yes, rate related. Now that I think about it, so it was in LQD, which is the investment grade bond ETF. We saw a lot of activity out in June. Some June call spreads. So we can see that these not the Febs here. Where's the other Junes? Yeah, the June 110s, and I thought the 108s. Let me just move out a bit here. I was pretty sure I had saw. Yeah, there they are. So the June 108s. This part of this, there was an 8,000 lot spread in the June 108 110 call spread. Traded 8,000 times. So that's what this 8,000 piece was all about. Some of that could have been closing on the 108 strike, because as you can see, there was substantial open interest there. Okay, so let's take a couple questions here. And also, I think, well, someone's going to get in my ear and remind me, because I remember there were some things that I was supposed to talk about from the last show, but off the top of my head, it's not occurring to me what that was. So Eileen says, "Hi, Mike. Carolyn Boroden is sometimes on Jim Cramer's show. She recently charted where the SPX 5-day moving average breaks below the 13-day. Guessing the SPY term structure has also moved higher." Well, we can take a look at that. I don't know that I would have... So the term structure, I would have expected that to steepen today. The reason for that is that, remember, we talked about this, I think, 2 shows ago, that the vol-of-vol is higher in near-dated options. So what that means is that, all else equal, we would expect the shorter-dated options volatility to swing about more than the long end, when that is true in both directions, higher or lower. So I'm going to get rid of this one from a week ago, and we're just going to go from one business day ago, and there you go. Okay, so I'm only going out to June, so this is reasonable. Maybe we can blow this up just here at the front end. I'm going to annotate here a little bit so we can get a look at this. You know what? I wonder if I should try my... I have some new annotating tools here, but actually for this purpose I actually wanted to do a measurement as well, so I'm going to stick with this one for the time being. So what we're looking at here is a decline from, so this is SPY now. We're looking at one-day options. So you can see that the one-day options before this economic release, you were looking at about 27 vol, and now you're looking at 16. So a decline of more than 11 clicks of vol in the front options. Now, this, by the way, I guess it depends how you look at it. So let's just think about this for a second. So you're going to see that there's actually a dot right here that lines up with the one that I was just measuring, and then there's this other one from yesterday that I'm measuring. So why am I doing that? This first dot that you're looking at here is the implied volatility of the one-day options yesterday. And this dot over here is the implied volatility of one-day options today. Another thing you can look at is this dot here, the second one on the red line. This was the implied volatility of today's options yesterday versus today. So you can sort of think about it both ways if you choose. If you look at where were today's options priced yesterday, you can see that that fell about 8 vol clicks. And one-day options premium, so how much the market is anticipating that the market would move over the course of one day, that has come down about 11 clicks. And if you go out 6 months, you can see that that difference is going to be far, far less. So this is 15. I'm going to round up. We'll call it 16 vol. And this is 14.6. So down 1.4 vol clicks in round numbers. A little bit less, actually, because this was slightly under 16. So that's what the term structure looks like right now. Now, this is a bit of a distortion for us to include these two numbers. So maybe a better way to think about the term structure generally is just to look at this portion of the curve from here on out. So the term structure is generally going to be upward sloping in a normal market environment. So I don't think that the term structure, and I don't know, Eileen, if this is what you were referring to. Were you talking about the term structure of vol? Or, yeah, because it's, I mean, it is steeper in the sense that the front came down because this was a really important economic release, but I don't think of that as being hugely, hugely steep. If that's something to think about. Okay. And you follow up by saying, as you've been saying, valuations seem pretty elevated. Not that I'm a chartist, but it wouldn't surprise me if the SPY dipped down to 480 sometime this year. Yeah, so that would be a pretty steep decline. Let's take a look. Just punch this out. So if you believe that it's going to drop down into that 480-ish level from where we are now, so that, it's interesting that you say 480 because 480 wouldn't be, that's not a bear market, but it would be bouncing around very close to that. And let's, I will say, I have somewhere. I should probably pull this up. I'll do that, as well, and maybe we'll keep that chart for just in terms of having some statistics. I'm going to see if I can pull up my spreadsheet where I can actually see how often that happens. Bear markets are not a hugely frequent event, but actually that might be a good moment to transition to something else, which I touched on in the beginning, which is Germany's GDP numbers. So Germany's GDP came in at negative 0.3% year on year. And that actually marks the second year in a row of declines. And, I bring this up because, we think about the economy being slow and we're hoping for at least 2% real growth, things like that. Real declines year on year are kind of rare. and it's meaningful. That's a formal recession. And what's difficult here is that, of course, Germany is the most important economy in Europe. So if we have negative growth in Germany, now I was seeing a bunch of people speculating about concerns about tariffs. Well, you can't really blame tariffs for 2 years of negative growth. First of all, the tariffs are not in place because what they're talking about are the proposed Trump import tariffs and their implications. Really what you're dealing with is the fact that you have very slow growing economies in Europe. Several of these have had real debt problems. And Germany has essentially been the economic powerhouse that sort of kept the region afloat. You add to this that they have some real demographic challenges, much like China does as a result of its one-child policy, much like Japan does, and that is that their populations are aging. So they have a higher number of pensioners and fewer young people coming up. Ideally, your population, if you're thinking about it from the pensioners' point of view, is a pyramid with them at the top, collecting benefits from the working populations below and even more young people below that. And that's not what they have. The United States, nor is that what China has, nor is that what Japan has. The United States is the closest that we've got to it. But I will say the following, which I think is just something to think about. It's kind of a futurist's sort of comment. But I will say that I don't know how many of your lives right now are impacted meaningfully by artificial intelligence, and how many fewer are meaningfully impacted by things like robotics. But I'm sure it's more than it was a year ago or 5 or 10. And I'm sure that if I polled most of you, and you can feel free to put this into the chat, but how many of you believe that AI is going to meaningfully impact how you live your life 5 years from now? And how many of you believe that robotics, for example, humanoid robots in your homes, are going to meaningfully impact the way you live your life within the next 5 to 10 years? Knowing that there's probably many of you, as I have, who've actually allowed your cars to drive themselves. If you have a Tesla, chances are you've experimented with full self-driving at one point or another. And that even includes those of you who didn't buy it. Because even if you didn't buy it, Tesla has been offering free trial uses when they do periodic software upgrades. I don't know if this is a national thing, but I believe that's going on right now. And I don't remember, I'm actually using this phone for something else, but I think that the trial that I saw, because my wife is not a big fan of full self-driving, it makes her very anxious, but I think that one goes until the 20th of January. Anyway, why I bring this up is because those types of productivity gains, if we have them, could be so significant that it can offset much of the secular headwinds that an aging population would otherwise create. This is really, really important. And I think potentially profound. So for the United States, if we can improve our efficiency, improve productivity, improve automation, I think this is one of the reasons why I'm arguably more optimistic than one might otherwise be. Add to that, and probably some of you saw this, the news that that there are some restrictions being imposed on exporting some of NVIDIA's technology. Other countries are balking at this, saying it's not reasonable, it's not fair. But what it does lead me to is that I think that the period of American exceptionalism that we've seen over the last couple of years, and that the economic data supports, is probably going to persist a little bit longer. Okay. So, Bob Loam, thoughts on Alphabet, Google, 205 Feb long calls. Post their quarterly earnings report. So, it's interesting. This is a name that I I've said it before. I like Alphabet. I think it trades at a very good multiple. Tremendous free cash flow. What was I just talking about? They're right in the thick of this. Obviously, they're in the thick of cloud, all the rest of it. You know, I am coming to you now via YouTube, probably. You might be on X, but it's probably on YouTube. And this is a company I really like, and I really like them because, you know, as I've said many times, what I'm looking for are companies. There's little reason to start hand-picking stocks unless you can get them absolutely dirt cheap. Unless the companies are growing the top line faster than the S&P does. And if they're growing their bottom line faster than the S&P does. And if they have better free cash flow yield than the S&P does. And all of those things, and if you also happen to believe that they are, you know, in a area of the economy that's poised to grow, is critical, and all the rest of it, and that they have some moat around their business. I believe all of these things are true for Alphabet. So, you know, this thing is trading, let's take a look right now. So 921 is what the street's looking for them full year. And by the way, I will say one other thing about this, which I think is kind of interesting. And that is, so what do we have here? 21 times forward earnings. 3 turns at least cheaper than the S&P. Now, obviously, it's up a decent bit today, but this is actually one of the few single names that I was going to, you know, present in another context, possibly tomorrow or Friday. Just so you know, because generally I think that when you're thinking about investment themes for a year or more ahead, you know, picking individual stocks can be a challenge rather than just sort of getting on broader themes. One of the themes I mentioned on Monday, one I still stick with, is that, you know, the growth rate for earnings for the equal weight S&P is, you know, over the longer terms, call it 7 to 10 years, comparable with that of the cap weighted S&P, but the valuation hasn't changed much, and that's largely because the valuation of a lot of the biggest names in the S&P have gotten quite large. This is an example, though, where there hasn't been that much valuation expansion. I mean, we can go back here and see, get rid of the price for a moment, but you can see if you go back a couple years, actually the turn on forward multiples has actually declined. And as we just saw, this thing is saying 25 times. I don't know why it's doing that. It's not correct. Because actually it's about 21 times. Oh, sorry. There we are. There's a problem. That's my mistake. Had the trailing numbers in there. Let me clean this up a little bit. There you go. So this is versus the forward numbers. Now you compare that to what's going on with this. And I should put this on a by field basis so we can look at them side by side. And you can see the green number, this is where the S&P was. Now, of course, this was probably a period of relatively low valuation, but let's just, you know, pick a number here. We go back to 2018, so the S&P was trading around 21 times forward in that neighborhood. So was Alphabet. And Alphabet's still in that same region, as you can see. I'll just draw a line. Maybe that'll make it a little bit clearer. Right? So this is probably, what is the, you know what I should do is I'm going to take a look at the average. So the average here for Alphabet is 22, and that's right about where it is now. So we'll put 22 in there. If you can't see it on the screen, just so you know, it's in the lower right-hand corner. Is that showing up? All the way down there in the bottom. Oh, maybe I can experiment with my little annotating tool here. So do that. Oops. So much for that. My annotating tool actually was basically hitting the escape button. All right. Work in progress here, folks. See if I can bring this back. So here's the part that I want you to pay attention to if we can see it. I was going to try to highlight it with my little tool, which I'm going to try to do in 1 second. See what happens. Is this going to hit escape again? Let's see. There we go. And so here we are. This is the part I want you to pay attention to down here. Do you see the box in red where I put average? Hopefully you do. So I'm going to get better at this just because I realize sometimes I'm putting a lot of data on there, and I thought it'd be nice if I could annotate from time to time so you could see it a little bit better. But it's around 21.65, and take a look at where we are right now, 21.23, right? So it's actually below the average for the past 3 years. You compare that to the S&P, and that's not the case. So there we go. So S&P, you're going to see that this number actually is throwing out a little bit above the longer term. Actually, we've got that we've got this anomalous data point, of course, in the S&P because of the pandemic. So I'm not sure whether that really makes a whole lot of sense to think about it that way. But here we're looking at a 5-year number. And again, draw a little box around that average so you can see it. There it is, 22.6. And where are we? 25. So it's trading about two and a half turns cheaper as a function of its own earnings forecast. So that's taking all of the street consensus, cap weighted. That's the number, and you can see that it's trading more expensive than Alphabet, which is forecast to grow top and bottom line faster. So, look, I mean, there's a benefit, of course. People will pay up for diversification. And then there's also this sort of big net idea, which is that you cast a big net and you're likely to catch some of the things that we're not anticipating are going to be real growth stories. But I do think it's important nevertheless. Okay. So, yeah, I like Alphabet on the long side. You might even consider going a little bit longer out there, Bob, and maybe selling some nearer dated upside calls against it, get into a diagonal, something like that. Hi Mike. Are you expecting legs in this CPI rally, or is it a short-term sugar high? Thanks. So here's the funny part about this, and that is that the market feels very schizophrenic to me where this inflation data stuff is involved. One of the things that I think the Fed has signaled is that they're not in a huge rush. They're not in a huge rush to reduce rates. And if they see any sign, I think, that inflation hasn't been licked, they don't want to be, I don't think that Powell wants to be Burns. And for those who don't remember, basically in the 1970s, the Fed they figured they had inflation licked well before they did. And it wasn't until Paul Volcker came in, who was appointed by Jimmy Carter, it should be said, since he just died. I figured I would mention that. It was Paul Volcker that ultimately solved the problem. And Arthur Burns basically figured he had the problem solved before he did. Nobody wants to be thought of. When people are looking at the oil paintings on the wall, that's not the image that Powell has for his legacy. So I'm sure they're going to be cautious about it. That said, liquidity globally does seem to be dropping. And having economies that are struggling, big economies struggling, like Germany's, like Europe more generally, like China, all of those impacts in the aggregate are deflationary. So, I don't think that this situation that we have right now is going to persist, where we have these wild spreads. I think somebody was pointing out recently that the 20 or 30-year spread, China versus U.S., has never been wider. It's more than 300 basis points. We can look at that in a second. But I will say that I think the market's a little bit schizophrenic on the rate picture, but I do think that some of the inflationary pressures that people are baking into their rate estimates are excessively pessimistic. And by the way, as I mentioned on Monday, there was an economic growth forecast that had come out that had, the U.S. economy growing, 1.5% or something like that. I also thought that was pessimistic. So I think it's worth knowing where I'm coming from when I, give a prognostication about whether or not I think the market's, we're dealing with a short-term sugar high or not. Okay. Ed Kendall, AMD, waiting for greatness. What strategy would you employ? So let's take a look at AMD. So they're going to be reporting on the 4th of February. Implied one-day move, 1.4%. Yeah, I don't think so. Bloomberg is not calculating that correctly. I can promise you with a 9% average implied move, that's not correct. So just to put things in perspective so we understand why you'll get an error like that in case you happen to use a calculator or you see something that comes out and says that that's the case. What is going on there is that very frequently implied move calculators that are doing it based on strictly on volatility, what they do is they will pick the first expiration that captures the event. That's going to be this one here, Feb 7th weekly, and compare it maybe to the next one or the next one after that. And then they essentially average it out. We can see the implied vol is higher, 52 versus, whatever it is here for March, which is about the same as it is for May, which is 45. Couple of things that could be going on here. One is that, there may be some volatility baked in the cake here that other news coming out is going to also have an impact. And so that will distort things a little bit because then all volatility goes up and it makes the relative difference in the term structure less significant. And so the implied move is less. In truth, this term structure should probably be, under normal circumstances, more upward sloping, but it's being propelled by some of these other factors. So my guess is that, with a couple more days passing and probably as early as next week, we're going to start seeing that the implied move based on some of these calculators is not going to be 1.4. This time next week, it's probably going to be 5 unless there's otherwise big shifts. But this number is going to rise, and it's going to become more in line with the kinds of implied moves that we have seen here before. All right, so on the technical front, how are we looking going into earnings? Well, let's just sort this first by the best technical indicators. Best technical indicators over the course of the last year out of these, 30 or so, 20, I guess, 22 of them, are going to be those that actually, had you followed their signals, would have resulted in nice profits. And what we can see here is that most of them, including the top 2 best performing ones, Bollinger Bands and Trading Envelopes, are indeed bullish. Other things I like to look at. How is the street's forecast going? That's what this little triangle in the upper left hand is. So are ratings for the street improving or declining? So what are the ways that they can improve or decline? Earnings estimates. Are analysts raising their estimates for the forthcoming earnings? Are they raising or lowering their price targets? Are they raising or lowering their buy, sell, hold, or whatever thing that they use? We can see here that this is negative, but then if we scroll down, we can quickly see why. There haven't been any increased ratings, any increased targets lately, but there have been a couple of reductions. So frankly, over at HSBC, he actually has it formally as a reduce. I don't know. Probably don't have access to anything of theirs. No, I do. 72 unentitled documents. So looks like that was over here. That was this one. Downgrade to reduce. Some of you may have other sources, but this is the article that you would be looking for if you want to know what was on Lee's mind. when they lowered their rating. So this was the piece that they published on January 8th. It was called Downgrade to Reduce AI Roadmap Proving a Bumpy Ride. I will say, the CEO has really tried to use that as a buzzword, hasn't she, on so many of their recent calls and presentations. AI, trying to put themselves forth. And I'm not saying that it's not true, but what I will say is that they're leaning into it pretty hard. So when they do that, that creates it creates a higher hurdle for themselves, because every earnings, everyone's going to be asking that very question, what's going on. So, and then also here at Goldman Sachs, and I'm not sure what their thinking on this was. So that was 2 days later. They reduced it to a neutral. And we're going to quickly see. Oh, here I can't even see the... All right. I was hoping I'd at least be able to find the title of that one, but I am not seeing it. So on the fundamental front, the street's generally still quite bullish. The average analyst price target is $1.75, so substantially higher, 46% higher than the current stock price. The technicals look generally good, and we have that upcoming catalyst. And now let's just very quickly take a look at valuation for AMD. Number one, how's it stack up relative to its history? 23 times forward. It's at the lower end of its own valuation multiples. And interestingly, it's trading at a discount to the market as well. So 23.6 times forward. And we're looking at year-on-year anticipated growth rates, full year, 50% EPS growth. I mean, I'll tell you, if the street consensus is anywhere close to correct, where they're looking for 26% year-on-year top-line growth and 50% adjusted net income growth, and it's trading 23 times, that's pretty good. That's very attractive. If we're just, again, coming up with a simple way to think about it, that's a peg of about 0.5, maybe even a little less. Not bad. Oh, yeah, and actually on a trade, well, let's take a look at this. So let's just quickly structure a trade for you on that one. Actually, let's just also very quickly take a look at how this thing has performed over the course. So you can see that over the last 8 reported quarters, 4 pretty good size moves. I'm going to call this one a push. 2.5% move. Don't really care that much about that one. So that was January of last year. And actually, we could even break this down and think about it seasonally. Does it? Sometimes you have quarters that are more meaningful than others. An example of this would be, how important is the quarter ended December 31st for a retailer? That does 40% of their sales around the holiday season. Obviously very important. So those moves will tend to be greater. We've seen that kind of thing around some of the transports too. Federal Express being a good example that, there are certain seasonal impacts where their situation is much different. Okay, so trades that one could do. I'm going to give you one that's neutral and one that is... So usually what I'm looking for is that bigger implied move. So you got to keep an eye on that, because right now that implied move is a little bit understated. And what that suggests, to me at least, is that the term structure is flatter than would usually be the case here. Because remember, the implied move when they're just using vol is taking a look at the first expiration that captures the event and then some subsequent one. So if the implied move is very low, what that tells us is that the term structure is not in as much backwardation, or is not as inverted as you might expect it to be. And consequently, trades that I usually really like to use in circumstances like this, like a strangle swap or a diagonal call spread, might not be quite as compelling. So perhaps a better way to do it then would be just to target the event, if you'd like to do that, and use something like a call spread risk reversal. So you're taking that term structure element out of it. And like I said, we're going to have to revisit this in a week or so, because I expect that term structure should normalize, and we should see a higher near-dated implied vol relative to the longer-dated stuff, but we're not seeing it now. And because of that, it's not, right now, it's not setting up well to do a trade I otherwise would like. So what did I say? It was the 4th, I think. So we can just go back. Even nothing wrong with actually just using the regular ways to do something like this. So you could do something like a call spread risky or just an outright call spread. And let's take a look at what something like that might be. Why is it, I have to switch that over to calls. Maybe, and actually the other thing I was going to say is that I think we figured out that the average move is about 9%. So we're looking to get, a $10 plus call spread out of this if you're trying to capture that implied move. Now remember that 9% is just for the earnings. So if we expand this, so we're looking at the 4th, and today is the 15th, right? So we're actually going from, I think the most I can do is something like 15 days prior to 5 after. Oops, sorry. Let me go like this. Minus 15 to 5. So here you can see that the average absolute price move is substantially larger, right? Because there's the difference between how much the stock's going to move just when they report versus, trading a little bit going into the event and trading for a few days after. As I've pointed out, when it comes to big institutional holders, usually it takes a few days for them to execute their trades. And so if they decide that they're going to, pile into something that they already own, or if they're going to start reducing, that's not an instantaneous thing. It takes some time to execute that. That will weigh on a stock if they're sellers, or it will buoy a stock if they are buyers for several days thereafter as institutional actors continue to act. So as we think about this call spread, and I was thinking about that implied move, and I was saying, okay, that's going to be a 9%er or something like that you're interested in, bear in mind, you have to think about where in the calendar you are, right? So here, we're not going to go to $10 out of the money with something like a 120, 130, because that 120, 130 would be a day of kind of a thing. So 16%, which is nearly double, is going to be more like something like this, more like this 120, 140 call spread. It's going to look a little bit like this. Ideally, we would get a trade like that off for around $5 or a quarter of the distance between the strikes, get yourself a nice 3-to-1 payout. But this is pretty close. Okay, let's move on. Blackmont video. I don't think people really know how much they are impacted by AI. There are so much already in terms of search results as presented. That's a good point. So as you think about that, really think about it, and chances are it has more of an impact on your life now than you think. I was listening to a podcast that Elon was being interviewed on very recently. I'm not sure whether that was today or yesterday, but I hadn't heard it before. I was out walking the dog, and oftentimes that's a good time to listen to podcasts. And he made a couple comments that I thought were really quite interesting. And among them was that what they're seeing in their results is that AI is doing a better job for things like medical diagnosis, reading x-rays, than even experienced physicians are. Statistically significant improvements. So able to outperform something like 80% of experienced radiologists for cancer diagnosis or something like that on really important benefits. Eileen, thank you. I was looking at 2 low points on a SPY 5-year chart and trying to extrapolate, but I'm more often wrong than right. Well, look, there will be a bear market, Eileen, at some point. I don't know when. If I did, well, I'd probably be able to charge for this live stream then. But we do look for symptoms, and one of those symptoms, I've said this before, when the market starts rallying and we start getting these sort of breathtaking gaps. You can imagine, and I can remember when I was a kid and I was riding in the back of my mother's station wagon, and she would go over, cars had much squishier suspensions, it seemed like at that time. You go over a rise and you could sort of feel your stomach, come up. What I have seen is that when the market gets extended, there tend to be bigger air pockets below stock prices, bigger gaps. And so rather than seeing steadily increasing prices and steadily decreasing vol, you'll see increasing prices, often with price jumps. Derivatives, traders like to sometimes talk about a non-continuous pricing. So you get price jumps up and down. And the thing that I always would worry about the most is when you gap higher to a new all-time high and close lower. And then oftentimes you will see increases in realized and implied volatility, even if the market's trading very near its all-time highs. And that's cause for concern in my view. For a stock replacement strategy, I bought a few SPY Jan 2026 500 calls a few weeks ago. Delta was 85. I occasionally wonder if this will be okay. What do you think? Targeting SPY 640, 650 sometime in 2025. So, buying a Jan 2026 500 call is comparable to owning SPY with a 500 Jan 26 put in it. Let's compare both of those very quickly so people can think about this. If you have the call, you don't get the dividend, but the dividend is not that great. I think SPY's dividend yield is like 1.1, 1.2, something like that right now. Oh, yeah. Well, I don't have to speculate. So the calculation on the estimate right now per options play, if you can see this, which is probably a little bit difficult to see. Let's see if we can try this annotating tool again, and let's see if I can point this out. So if you happen to be using options play, where you're going to see that right over here inside that box, that's your div yield number, 1.2%, anticipated dividend of $7. So let's just quickly construct this. First things first, the trade you've selected, which is the Jan 500 calls, deep in the money. Now, I've heard people recommend this as stock replacement in the past. It's not a strategy that I have used. First of all, I'd always rather be long the underlying stock. I just think when things go sideways, it's good to be long stock or to have access to it. I mean, you can imagine, for example, that if you had constructed something on the put side in Silicon Valley, I have had people reach out to me and say, I bought puts in Silicon Valley, the stock stopped trading, and my broker wouldn't let me exercise my long puts because I didn't have a borrow on the stock. Well, if you had created a synthetic simply by buying the stock, buying longer dated puts, selling calls, and then use that structure essentially to take a term loan on the stock and then, done something like bought puts, you'd add the stock to use. And that would have been kind of nice, as it turns out. So all else equal, when it comes to synthetic positions, I would prefer to own the stock. So this is the long call right here. All right, so how much is the extrinsic premium on this thing? So that thing is costing you $120, and it's 90 in the money. So not an inconsequential amount of decay. It's got to get to 620 for your break even. Let's compare and contrast that to a situation where you might have been long the stock and long a January put, 500 strike put. I'm going to get rid of that call in a second. Bear with me. So that would look like this. And you'll notice that the break even is essentially at the money. And, there's also the $7 in dividends that you're going to get on a long stock. So why is this? Why is the break even on this one so much lower or lower than this one? And the reason is the cost of carry, which is interest. if you buy that call, you do not have to commit as much capital as you would if you bought the stock, right? Because you're spending $120 per share to buy that in the money call option versus paying $5.90 a share, $5.93 as of today's closing price, plus paying up for that downside put, and that downside put's going to cost you $10. So it's really $600. And so the difference in that break even should be the dividend that you collect on this side plus the amount of interest that you would expect to get on the cash balance. Now the cash balance is really based on the strike, not the purchase of the stock, because you're buying it in the money call, so you're already laying out $120. So the difference is about $480 over the course. We're going to use round numbers, so $480 1 year is about 5%, is $24. So that works, right? So I don't know if everybody followed me on that, but if you buy the stock and you buy the put, you're going to be spending about $600 and about $600 round numbers. We'll call it that. You're going to get a $7 dividend. So 603 minus the $7 dividend gets you to 596. Versus spending $120 on the call. So 596 less 120, and then that would be the cash balance that you would otherwise be able to keep in your account, like for like. And then whatever rate of interest your broker would pay you on that cash balance, which actually brings up an interesting point because they're not all the same, right? So I don't know who your broker is, and I don't know what they're paying you on your cash balances. Some brokers are very aggressive and competitive in this area, and some are not. JP Morgan, Bank of America, and Wells Fargo were, when short-term rates skyrocketed, there was a huge spread between what they were paying on demand deposits and what regionals were. And the reason was because those banks are considered too big to fail. Because they were too big to fail, a lot of businesses and others were putting their money in there. They had to put their money in there. They wouldn't put them in the regionals because they were all concerned. And so consequently, the interest rate wasn't that great. So why do I bring this up? Because if your broker is not paying a really competitive short-term rate on your cash balances, then you are better off owning the stock and buying the put and collecting the dividend. If you're getting 5%, well, then you can do the math and say, all right, well, in that case, I'm going to bet that dividends don't rise and all the rest of it. And you might actually be better off by 100 basis points or 200 basis points or so to do it the call way. But that's something you need to pay attention to. So that's for all of you. If you're contemplating synthetics that have very comparable payoffs, these two have very comparable payoffs, right? Look at the shape of that. That and this are effectively the same trade synthetically. One, you own the stock and you get the dividends and you have a downside put protecting it. And the other one, you are laying out less capital, but you don't get the dividends. Voting rights, if that's important to you. That's probably not going to be important to you in an ETF context, but personal preference, market makers, people like myself, former and current derivatives trader, all else equal, would always rather be long the underlying. So I hope that helps. But the strategy's probably fine. I will say, think about this though, right? So your downside protection, if you have the 500, is $92 versus the current, plus the fact that you're paying over to buy it, right? So we'll call it $100. I mean, how much downside protection are you hoping for? Your downside risk is still 16.7% in the long call. And let's see. I don't know what the vol is on RSP because this is, I think I mentioned this on Monday, that price earnings to growth, if history is a guide for the equal weight, looks better now than the cap weight does. Okay. So annotation tool to try, Microsoft Sys internal zoom it. Okay. Yeah, that is a conversation not for me, but for the producers of this program, and I can see that they are paying attention. Alex V, I expect serious AI privacy regulatory pushback in the next 3 to 5 years, slowing things down. EU is likely to lead. Yeah, could be. But I will tell you, this train has left the station and it's building up speed. And the potential positive impacts are so great that it's going to be very difficult, especially for budget-constrained regulators. Bear in mind that industry, rightly or wrongly, is going to tell politicians this is the solution to all that ails you. You guys have ignored your fiscal budget deficits for ages. You have all of these other problems. This is going to fix it. Consider, as a really good example of this, I don't know if I brought this up. Someone was talking about Palantir. I may have talked about it. I'm just going to bring up very briefly use Palantir as an example. So, for those of you who are not familiar with Palantir, and I'm sure many of you are because it was, was it the best performing stock last year? It was very close to it. So, what is Palantir? Palantir is, is a company that is providing services to governments. And really, the best way I like to think about Palantir is what would the defense industry be if it was run by Silicon Valley rather than just being an amalgam of pre-existing defense contractors. What are you looking at here? So what you are looking at here, I'm getting better at this thing. Over here, you see all of this? This is who the company sells into. Every single time you look at who they're selling into, one of the things you're going to see is that a lot of these entities... Oops, sorry. I just hit the escape button twice. A lot of these entities are government entities. And let me give it was actually an example that Joe Lansdowne, is that his name? Is that the founder's name? Joe Lansdowne, is that, I think that's it, Joe Lansdowne, I should know this off the top of my head. One of the co-founders, how about that? We're going to leave it at this. So one of the examples that they gave, which I think is a phenomenal example of how important robotics, AI, and technology are, is that if you think about some of the Joe Lonsdale, thank you. Okay, so I was just reminded, Joe Lonsdale. So why this company is so important is, imagine this. You have legacy people in the military-industrial complex. The old line defense contractors generally operate. So I'm talking about LMT, Lockheed Martin, GD, General Dynamics, Boeing. Actually, Boeing is a huge defense contractor. These companies, when they work with the government, work on what's called a cost-plus model. What that means is the Defense Department decides what they want. They work with the defense contractors to help spec out what it is that they are looking for. They try to work collaboratively on the development of said products. Doesn't matter, like Raptor fighter, stealth bomber, cruise missiles, whatever it is. Spec these things out, and then the defense contractors operate on a cost-plus model. So they're not allowed to essentially charge any profit margin that they want. The logic on that would seem kind of evident on its face, which is that, this way these organizations can work with each other to develop products to the specification of the Defense Department and not get scalped in the process. But in practice, of course, there's a huge flaw in this business model. And I think maybe the best example of this, and it's one I think, and that's why I was trying to remember his name, that was brought up, is that in modern warfare, and we have seen this in the Middle East recently, drones are playing a big role. And we're not talking about really expensive, fancy drones of the type that we use, but relatively basic drones that are coming off in huge numbers. Well, if we use something like Iron Dome, which is what Israel is using, so we use air-to-air, missile-to-missile technology to go against drones, what you could end up with is, a cruise missile. I mean, people will remember this. The Tomahawks that Clinton sent to go get Osama bin Laden in '98, I think that was the year. They were saying, oh, he's sending $2 million Tomahawks up a camel's keister because they thought he was training. He probably was at a camp in Afghanistan, and they went in and they missed. But my point is that it is a losing battle if the U.S. Defense Department is fighting against camels or mules or cheap Chinese drones with $2 million missiles. That is not cost effective. They could bankrupt us very quickly doing that. So what Palantir has developed in this particular context is a directed energy weapon that can take out a multitude of drones simultaneously at no incremental cost other than the energy itself. So that kind of innovation and that kind of an approach is really important to the economies of developed nations so that we don't end up fighting these bizarre asymmetric conflicts where we're spending massive amounts to defend against relatively inexpensive and rudimentary attacks. Okay. So I'm being reminded, didn't mean to get up on a soapbox here, but that's the thing about companies like Palantir and all of these technologies that I think are going to be represent a huge opportunity. So the question about the collar was, where's the collar? The collar question. Where is it? Did I put that up on the screen? I was asked about collars. I like them. Yeah. Oh, here it is. Sorry. There it is. I had to scroll. So I like them, and especially like them in a rate environment like this, because if you're going to be long the stock anyway, they set up quite favorably. We can use AMD as an example. So we're going to put that in. I don't know how long you've had it, how long you can tend to hold it, but if it's a long-term hold, there are potential tax implications on using collars, but I'm just going to talk about it from a perspective of, let's say you have this in a self-directed IRA, and your intention is to hold it for some time. Stock was 170, it's now about 120-ish, so you want to hold this thing for some period of time. Let's just say that you said to yourself, okay, I want to collar this thing up, but I want to go out, really far. I want to set and forget so that I just have upside on AMD going out a couple of years. So I'm going to sell an upside call, and I'm going to buy a downside put, and own the stock. All right. You can get yourself into, let's see here, this is 120, so I'm actually going to punch that out a decent bit. What was this? This was the 95 put, it's $13. So what is a $13? That's the 210. There you go. Okay. So that structure, which you're going to put on for close to even money, has downside risk to, call it $95, but participation, again, at even money premium. Cost of carry, not to be dismissed, because you can earn 5% on your money risk-free, thereabouts, right now, but gets you upside at no net outlay to 210 over 120. So that's 75% upside versus 20% downside. So I do like them. I did not like them in other contexts when the rates were substantially lower. And the reason is because people own stocks. So when you think about this arbitrage, oh, well, I could earn 4% risk-free, chances are that's not what you're going to do. So, that's fine. On the short-dated ones, here I'm a little bit less enthusiastic. This is going to be case-specific, right? Because Unfortunately, the way the IRS, this is not intended to be tax advice, but I suppose you just take this into consideration. The way the IRS options rules work, so they have something called the mixed straddles rule. Basically, this is going to sort of fall into the same quagmire. But the important thing to think about is that depending on the nature of the account, and you're going to need to check this for yourself because I don't know your circumstances, but there is a possibility that in some circumstances, the IRS will not allow you to offset the premium spent effectively on the put against the call as part of the mixed straddles rule. And so you're going to unfortunately need to just double check what is going to apply to your particular tax circumstance. I'm fine with it absent the tax consequences, but I'm just, the unfortunate reality is that people's tax circumstances are different. How these things are going to be treated is different. I don't mind it going into an event like earnings, but something else you could consider, and probably the trade I would prefer, would be a put spread collar. So let's just take a quick look at what that would look like. And that's going to look a lot like a call spread risk reversal, by the way. So if you own the stock, and this is the last one I'm going to have time for today because I realize I've already dragged you guys into this for quite some time. Oh, IRS is not a, oh, okay. You're in the EU. Okay, so you're not dealing with the IRS. Lucky you. Okay, so then it's totally fine. Even so, I would contemplate using a put spread collar, because if it's short dated, the truth is you're probably not thinking, oh, AMD is going to fall out of bed and lose 50% of its value over the course of the next 2 months. So consequently, what you can do is you could buy, say, an at the money put and sell something further out of the money, so 870 versus 120, and then sell an upside call, for some comparable amount of dough. We'll go out to here or something like that. And we'll go like this. So you could do something like this, and you're going to end up with, some decent protection. So you get most of the participation to the immediate upside, and you're going to mitigate most of the downside for the first, $20 or so. So if it's just around a catalyst, I'd probably prefer this to using, just an outright collar. And thank you for elaborating. I don't have to worry about providing tax advice to people in the EU. I have no idea what taxes apply in your case. But this is something you might consider. Okay, so I have chewed up well over an hour of your time. I thank all of you very much for joining. Hit the like button, put in a comment, even if it's a -1, then I can just use that as constructive criticism, and I will try to adopt it in the future. I think all of those things help the algorithm. Tell your friends, and join us for the next one, which is going to be on Monday at 4:15 Eastern Time. Unless it isn't, hit the notification bell just in case we do a live one some point in between now and then. Thanks for watching.